there's a lot of speculation going on these days. So there's a lot of margin debt out there.
Morning, gentlemen. I have recently been reading an article that says margin debt in the stock market is 35% of GDP. I have a hard time believing that, Joe.
Well, that's because it's not true.
Okay, well, then I guess we're done for today. So,
America is a math challenged place, buddy. Let me tell you. This article was in a well known publication. Should we say who it is? Do we care?
yeah, go ahead.
As Forbes, which used to be a good magazine. I don't know what the hell's happened to it. It's kind of a cesspool these days. I don't know. Some Forbes staff writer wrote this article about, oh, it's a bubble. It's not just an AI bubble. It's an everything bubble. Oh my God, it's just the world's coming to an end. Yeah, you need to ignore that stuff. Look, margin debt is high, but it's not 35% of GDP. This dude had a decimal problem. It's 3.5% of GDP, and which is still a big number. Um, Look, margin debt is, I think, at an all-time high. And of course, you have to think about it relative to the market cap of the whole market and so forth. But it is, there's a lot of speculation going on these days. So there's a lot of margin debt out there. And margin debt, in case, you don't know what it is, margin debt is basically money that people have borrowed to buy investments. If those investments start to go in the wrong direction, then the brokerage firm is going to ask for a little bit more money. And that's how you end up with, or they're going to tell you to sell the thing, whatever it is. That's how you end up with markets that move a lot further than you think they would, because leverage works that way. It works in both directions. When things are going up, leverage is a wonderful tool, boy. You can just make tons of money, and you can give it all back in a heartbeat. And I would remind everyone who's sitting out there that's got a margin debit. There's an old saying on Wall Street that stocks go up the escalator and down the elevator. And I would say it's more like Wile E. Coyote in that cliff. But anyway, I think there's two lessons here. One is don't just take everything that you read as gospel, because people make mistakes. And they're trying to build a narrative. Hey, things are really on edge here. We're about to fall off a cliff. Look, I think the market's expensive, and I think there's a lot of speculation going on. But I don't feel like we're about to fall off a cliff either, because generally these things are economy related. And the economy is what it is. It's growing at trend, maybe a little bit below, well, a little below trend. It's not awful. It's not great. We go through multiple accelerations and decelerations in every cycle. We're in a deceleration phase right now. That's just the way it is, but it doesn't mean you're about to crash. So margin debt, yeah, that's probably a problem, but it's not a problem for us because we don't have margin. We don't use margin. We don't have clients that use margin. We don't do that. It's a problem for us, I suppose, if everybody else starts getting margin calls and starts selling. But other than that, it's not something that we worry about too much.
Steve, listening to Joe, it sounds, at least to me, like there are a lot of people out there who don't understand margin and they've borrowed a bunch of money that they're going to be sorry to be hung with before this is all over.
Yeah, I mean it's a mixed crowd, right? There's definitely some folks that a lot of times tend to be more on the retail side. It's great when you're going up, and maybe they haven't experienced it so much when it's going down. And then there's more sophisticated players, and those can take it off pretty fast. And some of them do know how to use it. Some of it's machine trading. I mean, it really is a lot of different players in the market. But there's just a general rule that if you're in the market, especially if you're a retail investor, give some thought who's on the other side of that trade. They might be doing it full time with more resources than you. Uh, yeah, I was also going to agree with Joe. I mean, it's not a timing tool. It is an indicator though of extremes, and over a trillion is, we are at extreme, and even though around 35% sounds like a much better headline than around 3.5. 3.5 is still a pretty big deal. So we're sitting at record amounts, and it does kind of point to just another sign that we're a bit of an extreme. Now, things can always get more extreme, but also, as Joe pointed out, kind of the analogy of goes up like escalator, comes down like an elevator. If we get some bad news, if we get things moving in the wrong direction, leverage can come off really quick. I mean, it's a lot easier and there's more motivation to take margin off than if you're actually owning the stocks themselves, because now you're losing money you don't even that you borrowed. So this can come off pretty fast. It can exacerbate a move. At an extreme, there's more room for it to go down than for it to go up. But one other thing I would just kind of point out is there's this theory in the market called the greater fool theory that, especially if you're in a bubble, that the market will keep on going up until you run out of greater fool to buy it the next thing at the most extreme price and throw in whatever stock you think is that at a ridiculous multiple. Well, this is why that theory isn't actually true, because as long as the fools can borrow more and more money, you don't need another greater fool. You just need to put more and more leverage on, which is one of the reasons why you do want to pay attention to the credit markets. Because as long as they're borrowing, as long as they're throwing leverage on, things that seem kind of crazy can keep getting crazier. But at some point, that unwinds, goes the other way, and it's never because you hit a magical number in terms of the margin debt. It's something else that gets people pulling it off rather than putting it on. But it's one indicator to keep an eye on, and it does tell you we're at a bit of an extreme now, but it doesn't really tell you much about timing.
Guys, I have never used margin debt with any clients in the decades I've been in this business. And Joe, you're the historian. Did we see something similar to this in 2000 with a dot-com bust?
Oh yeah, yeah. We see this every bull market in a sense. It's not just bubbles. I mean, and look, you guys know I hate the term bubble. You never know it's a bubble till you look back at it and go, well, that didn't work out. If you look back and it did work out, you go, well, that was a bull market. So it depends on your perspective. I would say that another indicator of the degree of speculation is another stock in the market that I would like to point out, which is Robinhood. Robinhood is a broker, which I believe, kind of, they made this. This is the gamification of markets. They use social media. They do lots of things to encourage people to keep trading. Why? Well, because that's how they make their money. And that stock this year to date, is up a mere 245%. And over the last 3 years, it's up over 1,000%. And that's where all your meme traders, all your people that are trading things like, that don't really have any value because they're just being traded because they're being talked about on Reddit. That's where they trade. So that's another indicator that, hey, there's a lot of speculation going on. I want to come back to the thing, I'm sorry to chuckle. This client, I don't think will be watching this, but I do want to point it out. You got to be careful when you read things and you read headlines and stuff and you get panicky. You got to read and you got to have some skepticism. A client recently texted me and said, hey, I saw that Beyond Meat was up 100%. Didn't I say something about buying that a few years ago? And indeed she had. And I said, no, we're not buying Beyond Meat. And it is down over those last 3 years, is down 92%. It got to be one of those meme stocks here recently, and they did kite it up 100%, but it went from like 2 to 4. So you got to be careful when you're talking about percentages that you know exactly where you are on that chart. And in this case, that was one of those charts that went down into the right instead of up and to the right. These are the ones we're looking for. We don't want these. Okay. So just, take everything out there these days. Listen, media doesn't, let's see, how do I put this? Media doesn't exist as it did when we were growing up, okay? It just doesn't. Everything today is about sensationalism. And if they can write a sensational headline, they're going to find a way to do that. And they're going to find a way to suck you in. And they don't even want you to read the article. They just want you to click on the thing, and you're gonna read about 3 lines of it, and that will have exposed you to their ads, and they got paid, and they're done. They don't care. So just take everything with a grain of salt and do your own research, or have someone like us do it for you.
And I think we just need to do Star Wars investing. These are not the stocks you're looking for. So Joe said it. If you'd like some help with your portfolio, we'd be happy to talk to you. Just let us know at info@alhambrapartners.com.